Today we are digging into a must-see CNBC clip with Dan Ives from Wedbush Securities where he makes a bold call about the tech trade heading into year-end. He says tech will rally into year-end and most investors will miss it. That is a statement that demands attention, and we're going to break down exactly what he means and why it matters to your portfolio. I am going to play the Dan Ives clip from Squawk on the Street, and immediately after I will walk you through my detailed reaction and analysis of everything he said. Then I will show you my top 3 AI stocks I believe stand to benefit the most from this rally, and explain why each one belongs on your watch list right now. If you only watch one video today, make this the one. Hit the like button, help us reach 1,000 likes on this video, share it with someone who cares about tech and AI, and drop your thoughts in the comments below. Subscribe so you do not miss the next crucial market update. Alright, let us hear what Dan Ives has to say.
Dan Ives joins us now. Dan, I don't think it's surprising for people to hear you pound the table on the tech trade. You've been super bullish. Do you not have concerns now about monetary policy, as the market rethinks the cut for December and the overall frothiness or valuations around AI?
Yeah, look, Sarah, I get some of the nervousness, but I was just in Egypt for 3 weeks. And demand to supply for NVIDIA chips are 10 to 1. Demand's increased, about 30% since June from what we see. You look at hyperscaler, this is a CapEx super cycle. So it's my view, if you're in the second, third inning, to be sort of bearish and nervous here, I just view it as short-sighted because I think there's a tech bull market that goes on for another 2 years. And I think these are golden buying opportunities for the names that I view where Street's underestimating numbers 20, 30% over the next 12 to 18 months.
But do you think there will be a point where the CapEx should get more scrutinized? Until the profitability materializes to match the level of spending?
Sure, and look, and I get the scrutiny. If you look, obviously, Meta and Oracle, and you see some of the worries there, the circular financing in terms of OpenAI, but to me, it's all about you're building out a new economy on the consumer, on the enterprise front. For every dollar they put on CapEx, they're going to ultimately make $8 to $10 on that over the coming years. So I just think that is the best move for these companies in the arms race. And that's why for Meta, I've talked about, that's a table pounder on that stock in the sell-off. Oracle, same thing. And, so many times we've talked about in your show, these are the opportunities, whether it's DeepSeek or other moments, and then investors are like, I missed it. But these will be the opportunities. I think you're going to have a massive tech rally into year-end.
Dan, Oracle's a great example. What explains that early September gap getting filled as we are back to the 200-day here for the first time since June?
Yeah, Carl, I think it's just worries about debt, taking on financing, CapEx, the depreciation, the OpenAI pop. Did they get over their skis? And actually, I disagree. I think Oracle, this is a massive renaissance that they're going to see. You talk about they're 2% penetrated within their install base when it comes to AI. Everything they're doing are the right moves. And I think this sell-off here, we're going to look back 3, 6, 9 months from now. And this was just, I think, a golden buying opportunity on Oracle. And I think right now the nervousness is coming out, but it just comes back to 3% of U.S. enterprises have gone down the AI path. And I think that goes to 20% over the next 18, 24 months. That's what you're playing for, especially in the second, third, fourth derivatives. We see it, cybersecurity. Right. I see human proof authentication. I see it on, infrastructure, Nebusis, CoreWeave, and others.
Does that view extend to Tesla, which, as we said earlier this morning, is now red for the year and worst performing Mag 7?
I think actually Tesla is probably, of all of these names, that's probably the one to me that sticks out the most. Because in my opinion, the future about autonomous and robotics, Musk, obviously right now, wartime CEO, you look at the coming years, I think Tesla's a $2 trillion and ultimately a $3 trillion market cap because autonomous, 80% of autonomous, I think Tesla's going to own. So I get the stock selling off here because you can't see it in the numbers. But this is something where I look out, 600's base case, 800's bull case. And Carl, that's my view. I think this is only, like I talked about, this is just the early days of a fourth industrial revolution. And for the first time in 30 years, the U.S. is ahead of China when it comes to tech.
Yeah, that's the bull case, Dan. So aren't there going to be winners and losers? It sounds like you like all of the big players.
Yeah, and Sarah, there's going to be losers. If you look at Adobe, are they a loser? If you look at some of the other sort of large cap names, like they're trying to sort of, I mean, I think Salesforce, is going to be a winner, but they're obviously under a lot of pressure from a software perspective. You look at some of the infrastructure plays like a Cisco, they're turning it around. I think it's really more about the second, third, fourth derivatives in software. I look at names like Nebius, I look at names like CoreWeave and the sell-off, because it's all, to me, about for every dollar, and this is the most important stat, for every dollar spent on an NVIDIA chip, there's an $8 to $10 multiplier across the rest of tech. $3 trillion that's going to be spent in the next 2 years.
Right. But you, in your view, it's all the hyperscalers that are the winners, the Amazons, the Googles, the Microsoft, Meta, you said, is a table pounder. So everybody that's spending big now.
I view it as, if they're not spending, I actually view it as a negative. Like if Meta ultimately pulled back and they raise numbers for next year and they cut CapEx, I would view that as a huge negative, because Zuckerberg right now, wartime CEO, building out what could be monetization, an incremental 40-50% on advertising, on the consumer side, and even as they build out on the glasses and on the hardware side. That's the smart move for Meta. I also look at names like, when you think about, we've talked about like in the power side, nuclear, names like AVGO and others. I mean, this all is about the second, third, fourth derivatives. People think that this is sort of a white knuckle, clock strikes midnight moment. I've talked about it. This is nowhere near a bubble. It's a 1996 moment, not a 1999, 2000 bubble moment.
Is there any demarcation line between names you would like and not like? 𝗗𝗏𝗧 is a great example, where you're either talking about no profits or, in some cases, in quantum, for example, minimal revenue.
Sure. Yeah, and Gar, I think that's where you have to be selective in terms of like the winners and who ultimately is going to be there. I think there's going to be other nuclear plays, right? There's going to be other power plays out there. If I see the demand is showing cracks and I see customers cutting back, the ROI is not there, use cases aren't exploding, then we get negative. But to some extent, it's the opposite. If you look at where we are right now, and I just think like globally, given where U.S. tech is, this continues to be what you want to own. And I think for the winners, and look, if you focus just on valuation, 1 year out, 2 year out, you missed every transformational tech stock the last 20 years. And that's why I focus on, we talk about in our Ives AI30, like who are the winners in the different sectors.
Dan Ives starts off by addressing the pullback we have seen across major tech names. A lot of investors are nervous, especially with the Federal Reserve reevaluating the possibility of rate cuts in December. Usually when monetary policy gets tighter, tech stocks feel it the most. But Dan Ives came into this conversation with a very different tone. He basically said the concerns are normal, but the pessimism is misplaced. In his words, he sees these sell-offs as golden buying opportunities, because the demand behind the artificial intelligence boom is far stronger than the market currently realizes. He highlights one thing that most retail investors are not paying attention to. He just returned from 3 weeks in Egypt, and during that time, he studied chip demand coming out of India. According to him, demand for AI chips from India alone has increased nearly 30% since June. That number is massive. It tells you that the appetite for AI infrastructure is accelerating globally, not slowing down. Then he went into the hyperscalers. These are companies like Amazon, Google, Microsoft, Meta, and Oracle. He said they are in what he calls a capital expenditure super cycle. In simple terms, these companies are spending aggressively on AI infrastructure, data centers, chips, cloud upgrades, and robotics because they know the future economy depends on it. And according to Ives, we are only in the second or third inning of this entire technological shift, meaning there are still many years of runway ahead. One of the strongest points he made was about the return on investment for big tech companies. He said for every dollar a company spends on NVIDIA chips, they stand to make $8 to $10 in return over the coming years. That means these companies are not being reckless. They are investing because the payoff on the consumer side and the enterprise side will be enormous. This is why he kept emphasizing that the spending is not a problem. In his view, the real problem would be if these companies stopped spending. That would signal weakness, not strength. He used Meta as a prime example. In his words, Meta is a table pounder right now. The stock sold off recently, but he sees that dip as one of those rare moments investors look back on and say they should have bought. His message was simple. If Zuckerberg pulled back on his spending and tried to tighten CapEx, that would be a red flag. The fact that Meta is going full speed ahead is exactly why he believes in them long-term. Then he pivoted to Oracle, which has been under pressure because of concerns about debt, depreciation, and its partnership with OpenAI. But Ives completely disagrees with the bear case. He sees Oracle entering what he calls a massive renaissance. He pointed out that Oracle is only 2% penetrated within their existing customer base when it comes to AI adoption. That means there is a huge runway ahead as their clients begin integrating AI systems across their businesses. To him, this pullback is just noise before a major growth phase. Next, he introduced one of the most important statistics from the entire interview. Only 3% of U.S. companies have fully moved into AI adoption. He expects that number to jump to 20% in the next 18 to 24 months. If that happens, the demand for chips, cloud services, cybersecurity, authentication, data centers, and software tools will explode. And this brings us to the second, third, and fourth derivatives of AI that he kept mentioning. These are not just the big players like NVIDIA or Microsoft. He is talking about companies in cybersecurity, infrastructure, authentication, and even power generation, like nuclear companies that will support the massive energy demands of AI. Then the conversation moved to Tesla. This part surprised a lot of people. Tesla is down for the year and is currently the worst performer among the Magnificent Seven. But Ives sees Tesla as the biggest long-term opportunity of them all. He called Elon Musk a wartime CEO and argued that Tesla will eventually dominate the autonomous driving space. He still believes Tesla is on track to reach a $2 trillion valuation and even a $3 trillion valuation further down the line. He laid out a base case of $600 a share and a bull case of $800 a share because of autonomy and robotics, not electric vehicles. In his mind, we are still in the early stages of a fourth industrial revolution, and autonomous technology will become the centerpiece. He also pushed back against the idea that this market is in a bubble. A lot of people think AI stocks are overvalued, but Ives called it a 1996 moment rather than a 2000 moment. What he means is that the world is still waking up to the potential of artificial intelligence. The bubble years were when everything had already happened, but right now, we are in the early days of the boom, not the end. He also explained that if you make decisions based only on valuation, 1 or 2 years out, you would have missed almost every major tech winner of the past 20 years. Companies like Amazon, Apple, Tesla, and NVIDIA all looked expensive before they delivered their biggest returns. His message to investors was clear. Focus on where the world is going, not just where the numbers are today. Toward the end, he clarified that not every company will be a winner. Some will fail and struggle with profitability. Some will not scale. But the major hyperscalers and the companies tied to infrastructure, cybersecurity, and robotics are positioned to benefit from a $3 trillion wave of spending over the next 2 years. His final message was simple. The U.S. is ahead of China in technology for the first time in 30 years. The global economy is shifting, and artificial intelligence is the engine driving that shift. In his view, this is exactly the type of transformation investors want to be part of. So in summary, Dan Ives is telling us that the dips we see today are not danger signals. They are opportunities. The AI revolution is still in its early stages. The spending is justified. The adoption rate is about to skyrocket, and the companies building the foundations of this new economy are positioned for explosive growth in the years ahead. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's dive into the 3 best AI stock to buy now. First up is Advanced Micro Devices, ticker AMD. Founded in 1969, AMD has a long and storied history in the semiconductor industry. For decades, it was seen as the scrappy underdog, always chasing after larger rivals like Intel and more recently, NVIDIA. But in the last several years, AMD has completely rewritten its story, transforming itself into a true powerhouse in high-performance computing, graphics, and artificial intelligence. Once the underdog, AMD is now a dominant force in high-performance computing and AI. The company's journey from making basic microchips to designing some of the world's most advanced processors is nothing short of remarkable. AMD's relentless focus on innovation has allowed it to close the gap with its competitors and in some cases, even leap ahead. Today, AMD's chips power everything from gaming consoles and laptops to massive data centers and supercomputers. Their Instinct MI300X accelerators are designed to compete head-to-head with NVIDIA's best, combining GPU and CPU for massive memory bandwidth and efficiency. The MI300X is a marvel of engineering, built specifically for the demands of artificial intelligence and machine learning workloads. By integrating high-bandwidth memory and advanced processing cores, AMD is able to deliver the kind of performance that modern AI models require, at a scale that can rival, and sometimes surpass, the industry leader. Major players like Microsoft, Meta, and Oracle are adopting AMD's hardware, validating its technology, and creating a powerful network effect. These partnerships are more than just sales. They're endorsements from some of the most influential companies in tech. When cloud giants and social media titans choose AMD for their data centers, it signals to the entire industry that AMD's solutions are not only competitive but also reliable and scalable for the most demanding applications. AMD isn't just about data centers, they're integrating AI into consumer devices with Ryzen CPUs featuring dedicated AI processing units. This means that everyday users, whether they're working on a laptop or gaming on a desktop, can benefit from AI-powered features like enhanced video calls, smarter battery management, and accelerated creative workflows. By bringing AI to the masses, AMD is helping to democratize access to cutting-edge technology. This two-pronged approach, enterprise and consumer, diversifies revenue and embeds AMD across the computing spectrum. By serving both the world's largest corporations and individual consumers, AMD is able to weather industry cycles and capitalize on growth wherever it appears. This strategy also means that AMD's innovations in one area, like AI acceleration, can quickly make their way into products for the other, creating a virtuous cycle of improvement and adoption. The AI chip market is projected to be worth hundreds of billions, and AMD is well positioned to capture a significant share. As artificial intelligence becomes central to everything from healthcare and finance to entertainment and transportation, the demand for powerful, efficient chips will only grow. AMD's investments in advanced manufacturing, chip design, and software ecosystems put it in a prime spot to benefit from this explosive growth. Under CEO Dr. Lisa Su, AMD has executed flawlessly, acquiring companies like Xilinx to expand into adaptive computing and networking. Dr. Su's leadership has been transformative, guiding AMD through a period of rapid innovation and strategic risk-taking. The Xilinx acquisition in particular gives AMD access to new markets like FPGAs and adaptive SoCs, which are increasingly important for AI, 5G, and edge computing applications. Their open-source ROCm software ecosystem challenges NVIDIA's CUDA, making it easier for developers to adopt AMD hardware. By investing in open standards and developer-friendly tools, AMD is lowering the barriers to entry for AI researchers and engineers. This not only helps AMD win over new customers, but also fosters a vibrant community that can drive innovation and support for its products. AMD's EPYC server CPUs have already disrupted Intel's dominance, and now they're targeting the AI accelerator market. EPYC processors are known for their high core counts, energy efficiency, and competitive pricing, making them a favorite among cloud providers and enterprise customers. As AI workloads become more prevalent, the combination of EPYC CPUs and Instinct accelerators positions AMD as a one-stop shop for next-generation data centers. Demand for AI compute is so high that even as a number 2 player, AMD's growth potential is massive. The company's rapidly gaining market share, and its products are increasingly seen as essential infrastructure for the AI revolution. As more organizations race to build out their AI capabilities, AMD stands to benefit from a rising tide that lifts all boats, but especially those with the best technology. The company's reliability, innovation, and strategic partnerships make it a top contender in the AI space. AMD's ability to deliver on its promises, form deep relationships with industry leaders, and consistently push the boundaries of what's possible has earned it a reputation as a trusted partner for the future of computing. Risks remain. Competition is fierce, and the semiconductor industry is cyclical, but AMD's transformation and execution set it apart. The company must continue to innovate and execute flawlessly to stay ahead of rivals like NVIDIA, Intel, and a host of emerging players. Supply chain disruptions, economic downturns, and rapid technological change are all challenges that AMD will need to navigate. But its track record over the past decade suggests it's more than up to the task. Investors are recognizing AMD as a technology leader, not just a cheaper alternative. The company's stock performance reflects growing confidence in its long-term prospects, and analysts are increasingly bullish on its ability to capture a larger share of the AI and data center markets. Watch for adoption of the MI300 series, ROCm ecosystem growth, and continued data center gains. These are the key indicators that will show whether AMD can maintain its momentum and continue to challenge the industry's biggest players. AMD sits with a market cap of about $403.68 billion, and headline metrics show a high PE ratio, quoted at 129.9. Earnings per share are 1.90. Revenue in 2025 came in at about $25.78 billion, and net income was roughly $1.64 billion. If you dig into the quarter-by-quarter data, the valuation picture has shifted meaningfully, with the PE ratio coming down to around 78.28 times in Q3 2025, while EV to EBITDA holds near 41. growth remains the most compelling part of AMD's story. Revenue growth is robust at nearly 32% year-over-year, signaling strong demand for its products. Profitability is improving too. Gross margin sits near 48% and operating margin has expanded to almost 9%, which shows management is extracting better operating leverage and controlling costs as the business scales. Put simply, AMD looks like a growth company that is beginning to convert that growth into cleaner profits, but investors are still paying a premium for that runway. All signs point to AMD being a compelling long-term AI stock. With its strong leadership, innovative products, and expanding ecosystem, AMD is well positioned to ride the next wave of technological transformation. That's why it's first on my list. If you're looking for a company that's not just keeping up with the AI revolution but helping to lead it, AMD deserves your attention. Next up is Broadcom, ticker AVGO, a true giant in the semiconductor world and, in many ways, the backbone of today's rapidly evolving AI infrastructure. While companies like Nvidia often grab the headlines, Broadcom is the silent force making sure the digital world runs smoothly behind the scenes. Their technology is woven into the very fabric of the internet, cloud computing, and the AI revolution. Broadcom leads the industry in high-speed networking, providing the switches, routers, and custom silicon that connect AI servers in the world's largest data centers. These aren't just any components, they're the critical arteries that allow data to flow at lightning speed, enabling AI models to train and operate at scale. Their Tomahawk Ethernet switches, for example, are considered the gold standard for building massive AI clusters. Tech giants like Google, Meta, Microsoft, and Amazon rely on Broadcom's networking gear to power their cloud platforms and AI workloads. Without Broadcom's technology, the seamless connectivity and data transfer required for modern AI would simply not be possible. As AI models grow ever larger and more complex, the need for fast, reliable networking skyrockets. Broadcom is the go-to supplier for hyperscale data centers, providing the backbone that keeps these digital ecosystems running. Their products are trusted for their performance, reliability, and ability to scale as demands increase. But Broadcom's expertise doesn't stop at networking. They also design custom chips for the world's biggest tech companies, including Google and Apple. These custom silicon solutions are tailored to the unique needs of each partner, creating long-term, sticky relationships that are hard for competitors to disrupt. This approach not only drives recurring revenue, but also cements Broadcom's role as a strategic partner in the tech ecosystem. A major recent move was Broadcom's acquisition of VMware, a leader in cloud software and virtualization. This deal allows Broadcom to offer integrated solutions that span from hardware to cloud software, creating a powerful enterprise platform. By combining their hardware expertise with VMware's software capabilities, Broadcom is positioned to deliver end-to-end solutions for the world's largest organizations, making them even more indispensable. Beyond the data center, Broadcom's wireless division supplies critical components to Apple and other leading smartphone makers. Their chips enable fast, reliable wireless connectivity, which is increasingly important as AI moves to the edge, powering smart devices, wearables, and the next generation of mobile applications. As more AI features are embedded in everyday devices, Broadcom stands to benefit from this shift in computing. This remarkable diversification, spanning data center networking, custom silicon, enterprise software, and edge connectivity, makes Broadcom uniquely resilient. They're not dependent on any single market or customer, which helps insulate them from industry cycles and positions them for long-term growth across multiple sectors. Financially, Broadcom is a cash machine. The company boasts high margins, robust free cash flow, and a growing dividend that rewards shareholders year after year. Their disciplined approach to capital allocation, balancing reinvestment, acquisitions, and shareholder returns, has made them a favorite among long-term investors. In fact, Broadcom's consistent performance has allowed them to weather market volatility better than many of their peers. Their customer list reads like a who's who of the tech industry, including the biggest names in cloud, social media, and consumer electronics. These deep multi-year relationships provide Broadcom with valuable visibility into future technology trends and demand cycles, allowing them to plan and innovate ahead of the curve. The investment thesis for Broadcom is clear: dominance in high-speed networking, leadership in custom silicon, strategic expansion into enterprise software, and a proven track record of disciplined execution. Few companies can match Broadcom's breadth, technical expertise, and ability to adapt to new opportunities in the AI era. Much of Broadcom's success can be attributed to CEO 𝗗𝗓, whose strategy of smart acquisitions and seamless integration has built a powerhouse ready for the AI era. Under his leadership, Broadcom has consistently identified and captured new growth opportunities, while maintaining a laser focus on profitability and operational excellence. Of course, there are risks. Broadcom relies on a handful of major customers for a significant portion of its revenue, and integrating large acquisitions like VMware always carries challenges. However, Broadcom's strong track record of successful integrations and its ability to adapt to changing market dynamics provide confidence in their ability to manage these risks. Every time a new AI data center is built, every time an advanced smartphone is launched, and every time a custom AI chip is designed, there's a good chance Broadcom is involved. Their technology is everywhere, often invisible but absolutely essential to the functioning of our digital world. Ultimately, Broadcom's greatest strength is its diversification. By operating across multiple, high-growth sectors, data centers, custom silicon, enterprise software, and edge connectivity, they have multiple avenues for expansion and are well-positioned to capture the next wave of technological innovation. Broadcom's market cap is roughly $1.61 trillion, PE ratio is in the high 80s at about 87.81, earnings per share around 3.90, revenue in 2025 about $51.57 billion, and net income near $5.89 billion. The recent quarterly picture shows mixed signals. Valuation ratios and EV to EBITDA improved in Q3 2025 versus earlier periods, which suggests the market is warming back up to the name. Revenue growth has slowed to about 28%, but earnings growth has exploded, up 268.81%, indicating a strong profit recovery and likely better margin conversion. Gross margin and operating margin both improved, which reinforces the story that Broadcom is tightening its cost structure and benefiting from higher profitability even as top-line growth normalizes from peak levels. For investors, this reads as a company that is moving from heavy growth into a more balanced phase of revenue plus substantial margin expansion. Broadcom is the hidden giant powering the AI revolution from behind the scenes. While others may get the spotlight, Broadcom's technology is what makes the magic happen, quietly enabling the future of computing. That's why Broadcom is my second top AI stock pick, a company with the scale, expertise, and vision to thrive as AI transforms every industry. Let's move to the third. The third stock on our list is Supermicro, ticker symbol SMCI, a company at the very heart of the AI revolution. While many companies are racing to develop artificial intelligence software, Supermicro is quietly building the physical backbone that makes all this innovation possible. High-performance servers designed specifically for the most demanding AI workloads. Their products are the unsung heroes powering everything from advanced research labs to the world's largest data centers, enabling breakthroughs in machine learning, natural language processing, and more. What sets Supermicro apart is their unique modular, building block architecture. This approach allows them to rapidly design and assemble servers, tailored to the exact needs of their customers, whether it's for training massive AI models or running real-time inference at the edge. Unlike traditional server manufacturers, who often take months to adapt to new chip releases, Supermicro can reconfigure their systems in a matter of weeks, or even days, giving them a huge edge in a market where speed and flexibility are everything. Their agility means they can deliver optimized systems as soon as new chips from NVIDIA, AMD, or Intel hit the market. This is crucial because the pace of innovation in AI hardware is relentless. Every few months, new GPUs and accelerators are released, each promising more power and efficiency. Supermicro's ability to quickly integrate these chips into their servers means their customers are always at the cutting edge, able to deploy the latest technology without delay. This speed to market is a massive advantage as companies across every industry, from healthcare to finance to autonomous vehicles, race to deploy the latest AI technology. In today's hyper-competitive environment, being first can mean the difference between leading the market and falling behind. Supermicro's rapid response times and deep technical expertise make them the partner of choice for organizations that can't afford to wait. But it's not just about speed. Supermicro is also a pioneer in advanced server cooling, especially liquid cooling, a technology that's becoming essential as AI chips grow ever more powerful and energy-hungry. Traditional air cooling simply can't keep up with the heat generated by today's top-tier GPUs. Supermicro's liquid-cooled systems allow for denser, more powerful server racks, unlocking new levels of performance while keeping energy costs in check. Their early investment in these advanced cooling solutions gives them a critical edge as data centers push the limits of power density. With energy costs and sustainability concerns rising, Supermicro's efficient cooling technology is a major selling point for customers looking to maximize performance without breaking the bank or the environment. At the helm is CEO Charles Liang, whose engineering-driven culture permeates every level of the company. Liang's hands-on leadership style ensures that Supermicro stays laser-focused on customer needs and rapid innovation. He's built a team that thrives on solving complex technical challenges and that culture of relentless improvement has made Supermicro a trusted name in the industry. The results speak for themselves: explosive revenue growth, an expanding global customer base, and deep partnerships with major chipmakers like NVIDIA, AMD, and Intel. These relationships aren't just about buying chips, they're about co-developing solutions that push the boundaries of what's possible in AI infrastructure. In fact, Supermicro's preferred status with NVIDIA ensures they get early access to the most in-demand AI chips, allowing them to fulfill massive server orders that other manufacturers simply can't match. This privileged access is a huge competitive advantage, especially as demand for AI hardware continues to outstrip supply. While the stock has already soared in recent years, Supermicro's earnings growth and the overall market opportunity in AI servers are just getting started. The global shift toward AI-driven applications is still in its early innings, and the need for high-performance, energy-efficient server infrastructure will only accelerate from here. Another key advantage is their leadership in green computing. Supermicro's liquid cooling and energy-efficient designs help customers dramatically reduce their data center energy costs and carbon footprint. As sustainability becomes a top priority for businesses and governments alike, this focus on eco-friendly technology is a major differentiator. Whether it's a hyperscale cloud provider, a cutting-edge AI startup, or a Fortune 500 enterprise, Supermicro is increasingly the go-to provider for high-performance, customized AI server solutions. Their ability to deliver exactly what customers need when they need it has earned them a reputation for reliability and innovation. Of course, there are risks. Supply chain constraints remain a challenge, especially as global demand for AI hardware continues to surge. Competition from larger players like Dell and HPE is fierce, and with the stock's rapid rise, valuation is a concern for some investors. But so far, Supermicro's execution has been nothing short of exceptional, consistently delivering on both growth and profitability. SMCI's market cap sits around $21.74 billion, PE ratio roughly 28.68 at the headline, with earnings per share of about 1.27. Revenue is reported near $21.97 billion and net income about $1.04 billion. The most recent dynamics show the PE multiple expanding significantly into the mid-30s, with the ratio rising to about 35.93 in FY 2026 Q1 from roughly 27.89 in FY 2025 Q4, reflecting a rising willingness by investors to pay for earnings. Yet growth has cooled sharply. Revenue growth fell to about 11.94% from much higher prior rates, and earnings growth pulled back. Profitability has weakened as gross margin slipped to just above 10% and operating margin compressed as well. That pattern tells a cautionary tale. Supermicro is still generating cash and earnings, but the company is facing margin pressure and decelerating growth, which means investors need to be selective and pay attention to product mix, pricing, and cost control before assuming the good times will continue. For investors seeking pure play exposure to the AI infrastructure boom, Supermicro stands out as a rare opportunity. Unlike diversified tech giants, SMCI is laser-focused on the server market, giving shareholders direct access to one of the fastest-growing segments in technology. Their relentless focus on building the best, fastest, and most efficient servers for AI workloads has set a new standard in the industry. From blazing fast benchmarks to innovative cooling systems, Supermicro is constantly pushing the envelope to deliver unmatched performance and value. That focus is their superpower. It's what enables them to outmaneuver larger competitors, adapt to new technologies, and consistently exceed customer expectations. For all these reasons, SMCI is my third pick, a company that's not just riding the AI wave, but helping to build the very foundation of the AI-powered future. There you have it. 3 companies at the heart of the AI revolution: AMD, Broadcom, and Supermicro. Each plays a unique, critical role and is poised for significant growth as AI accelerates. Across these 3 profiles, the common theme is relative positioning. AMD is the growth engine that is beginning to show meaningful margin improvement. Broadcom is scaling into stronger profitability even as growth normalizes, and Supermicro is navigating a transition where multiples have expanded, but underlying margins and growth are under stress. Each stock fits a different investor mindset: growth with improving margins, large-scale profit recovery, or a higher-risk, cyclical growth story that requires active monitoring of margins and demand. Which of these stocks do you think has the most upside over the next 5 years? AMD's chip innovation, Broadcom's infrastructure dominance, or Supermicro's speed to market? Let me know in the comments. Don't forget to like, subscribe, and join our community for more in-depth analysis and exclusive stock tips. Check out the links in the description for more resources and to support the channel. Thanks for watching, and I'll see you in the next one.